Hello everyone, and welcome to the TradeStation Labs Spotlight On series. My name is Fred Pomleden, and I will be your host this afternoon. Today's presenter is Sam Seiden, Vice President of Education for Online Trading Academy. We'll get Sam started in just a minute, but first let me cover a few things. Let me get you familiarized with the broadcasting tool first. You can submit questions in the chat area in the lower portion of your screen. The chat is not privatized, meaning that everyone in attendance will be able to see your questions or comments. I will answer general questions related to TradeStation, and I'll let Sam handle questions regarding his presentation. But please, as always, please keep the questions on topic. Also, today's presentation will be archived and available for you on our website. It may just take a few days before the archive is actually posted. If you have trouble viewing this presentation, or if you have troubles with the sound, you can click on the blue X on the top right of your window. So no worries, this will not close the window. Instead, you'll have access to a submenu where you can choose to refresh the screen. If clicking on the refresh option does not solve your issues, you may need to log off and log back in. Also, if you get disconnected, just log on again and you should be able to join the room. You may also need to adjust your computer volume. So, of course, volume can be adjusted directly on your machine, but you can also adjust your volume if you notice at the bottom left of this window, there's a volume slider. Now, let's get some legal matters out of the way. The following presentation is for educational purposes only. So all symbols and trading ideas discussed by the instructors are for demonstration purposes only and are not recommendations. Also, active trading is not suitable for everyone. So do read the disclosure information in the PDF handout available in the Documents folder in the bottom right of the presentation viewer or on the TradeStation website. Today's presenter is Sam Seiden, Vice President of Education for Online Trading Academy. Sam will draw on his experience to address the current market environment. He has traded most asset classes for more than 15 years, while educating hundreds of traders and investors through seminars and daily advisory services, both domestically and internationally. It's great to have Sam here sharing his trading knowledge. Sam, it's all yours.
Thanks, Frederick. Everybody can see the screen okay, and I assume you can see the first page here. Market timing for short-term income and long-term wealth. Can everyone see that okay? Excellent. Give me just about 10 seconds here and we'll get started. All right, welcome everyone. So sound should be good. Just reconnected it. And let's get started. We've got about an hour together, so want to make the most of this. Now, if you have any questions or comments, you can certainly ask them. But I would suggest that most of your questions will be answered throughout the presentation. We will cover the core, the supply and demand concept, and we'll take that pretty deep. We'll dive into some odds enhancers, which really help supercharge a strategy. So hear me out, and I think you'll really get a lot out of the session. I do the Friday morning market briefings at TradeStation, and thanks to TradeStation for putting those on. But in that 30 minutes together, it's very easy to call out some good trades. But how those trades, why those trades are called out and why they work or don't work or what have you, that's what we're going to focus on today. And I thought, we've got an hour together. What's the most important thing that we could talk about? Whether you trade stocks, futures, Forex, options. There you go, Joseph. I turned it down a little bit. Sure. whatever asset class you trade, whether you're a short-term trader, longer-term trader, what's the most important thing we could talk about? What would have the biggest impact on your financial life as a trader investor? It's this concept of market timing. And when we say market timing, what I mean by that specifically is the ability to time the market's turning points in advance with a very high degree of accuracy. But not just being able to identify where market price is going to turn, but also where are they going to go. Okay, so that's at the heart of what we're going to discuss today. And we're then going to be able to apply this to the financial markets for the strategy for short-term income and long-term wealth. You'll see how we do that. And a couple other notes. Make sure you understand that everything we're going to talk to you about today, everything I'm going to talk to you about, is equally applicable across all the asset classes: stocks, futures, Forex, options. Okay. Also time frames. Anything I'm going to talk about, we would apply equally to all the time frames. Whether you're, again, short-term trader, longer-term trader, you'll apply the strategy rules and concepts equally. So let's dive in, and let me move forward here. I'm going to try to get through all the information here. Every Friday we're always looking at the charts, and here's the next trade, and here's the next turning point. The purpose, again, of today is to really dive into lesson. So I'm assuming and hoping at the end there'll be time to go into the live markets and start to really show you how we apply this stuff. So we should be able to do that, but if not, you can always join me on Friday mornings here at TradeStation. All right. So understand, and again, we'll start out, for those of you that have heard some of this before with me, I recognize some names here. We'll start out a little bit basic to bring everybody up to speed, and then we'll take it much deeper. So, understand that the financial markets really consist of two groups. There's always a buyer and a seller, but who? Who are the two groups that are primarily, active in the markets? About that? No, the screen should have changed. Yeah, so we're talking about the financial markets here. The two groups at play are institutions and banks together, and retail traders. Okay? Institutions and retail traders. Those are the two primary groups active in the markets. Right? If you're going to be a successful screen-based trader, I would strongly argue that you absolutely have to be able to identify those two groups on a price chart. In other words, you need to have the ability to look at a price chart of any market in any time frame and quickly point out that that is an institution buying there, and that's a retail trader selling there. Okay, that is crucial information, and we're going to focus on that today. The successful screen-based trader can do that. Right. Now. Yeah, the webinar is being recorded. You'll get more information on that later. So I didn't start out by reading trading books. Most people start out today, they read trading books or get some information online or maybe take a trading class. I didn't do that. I probably would have done it if those things had been readily available back when I started, but I don't even know if there were trading classes back then. I started on the floor of the Chicago Mercantile Exchange many years ago. And I had no experience in this business, believe me. Everyone with us here today knows more about this, knows more about trading than I did when I got started. I promise you. So just to kind of be quick here, this is actually a screenshot of the Chicago Mercantile Exchange. I did not start out in the trading pits here. I actually started out in the trade desk. And in the beginning, I thought, oh, that's not fun. That's not cool. I want to be in the trading pit like these guys. Boy, was I wrong. Okay, I had such a huge advantage and such an incredible lesson by starting my career in this business on an institutional trading desk. Okay, let me tell you, what every day was like. And what we're going to do soon is translate all this information onto a price chart very clearly with rules. So every day I would get down to the market about an hour before the markets would get going. I'd be answering the phones, taking orders from banks, institutions, money managers, hedge funds, some retail traders as well. And about 10-15 minutes before the markets would get going, I would stop answering the phones and taking orders because you had this big unorganized mess of paper in front of you. All right? So I would take that time and organize these orders and create stacks of orders, piles of orders, all according to price. Okay? So I put the buy orders on my left and the sell orders on my right, and off we would go. Now, one thing I didn't need anybody to teach me was where prices were going to turn and where they were going to go. I could tell you that and be right almost always. How was I so could I be so accurate? Because I had the orders in front of me, right? I had orders from some of the big banks, institutions. We were a huge trading desk ourselves, right? Now, as I'm saying this, make sure you understand this. You may be thinking that, oh yeah, what Sam's talking about now is our bids and offers that we see on our computer screens. Maybe on our level 2 screen if you trade stocks, or the matrix, right? If you trade futures, Forex, or stocks, or what have you. You're thinking, well, yeah, we see that today. We just see that in the bids and offers on the screen. No. Okay? Make sure you understand, I am not talking about those bids and offers that you see on your screens. Because I would argue that those don't really represent the actual bid and the actual offer. Now, how do I know that? How do I know that those don't represent the real willing buyers and sellers? Well, first of all, how many people here trade stocks, right? If you trade stocks and you intraday trade stocks, how many times a day do you see the bid like 10 times the size of the offer and prices fall? Or the offer like 10 times the size of the bid and prices rally, right? How many do you see? It happens all day long. Well, if those numbers were actually, 100% real, that would be physically impossible, right? Okay. Yeah, and then, so maybe you trade futures or Forex. Futures, for example. I'm sure a lot of people here trade the S&P. All day long, there's a few hundred to 1,000 on the bid, a few hundred to 1,000 on the offer. But when you look at what's really trading, it's like 1 lots and 5 lots, right? Most of the time. You think, well, that's odd. How can that be? Well, if that information was, there we go. It looked like we may have lost connection there. Sorry about that. Not sure what the last thing you heard me say was. What was the last thing you heard me say? Sorry about that. I didn't even know we were disconnected. I just kind of kept talking. Yeah, how could that be? Exactly. So how do I know that the orders that I was talking about on the floor were real compared to the orders you see on a screen? Well, first of all, it was completely illegal for me to trade my own accounts, right? I had to sign a stack of papers, saying that I would not trade any accounts that were tied to any markets at the Chicago Mercantile Exchange. Number 2, there were cameras pointing at you from every direction. It was like worse than a casino. Number 3, the phone lines were recorded. Every few seconds you hear the beep, right? Now, why was there so much security and scrutiny around what I was doing? Because what I had in front of me was access to the market's real willing buyers, demand, and real willing sellers, the supply, the real demand, the real supply in some of the biggest markets in the world. And my question to you is, if you have access to that information, do you really need anything else? I mean, if you knew where the real willing buyers and sellers are every day, every week, every month, do you really need anything else? Do you ever need to take a trading course or anything? No. Exactly. So my point to you is that picture that represents real institutional demand and real institution supply on a price chart is exactly what we're going to focus on today. All right? And nothing else. We're going to zero in on that. So we're going to do 2 things. I'm going to show you next what those demand and supply levels look like on a price chart. And I'll give you the basic version, and then we'll take it deeper with some odds enhancers. The second thing we're going to learn to identify in a chart is to identify the difference between an institution trader or a bank and a retail trader. All right? So let's do that. You may be thinking, well, how come everything, some of the things I'm going to say may sound very different from conventional wisdom. Well, again, it's not that I'm smarter than anybody else. I just had a different starting point. My perception and perspective from the beginning was literally opposite of most people. And I'd love to say it was by choice, but it wasn't. My friends worked down at the Merck CME, so I wanted to work down there. That's all. All right, take a look at the screen. Let's start to translate all this information onto a price chart. And again, I'll go through this part kind of quick, and then we'll slow down as we get to into the odds enhancers. So step number 1, let's identify real institution supply and demand on a chart. So prices were trading sideways right here. Supply and demand appears to be in balance, right? Looks like for every buyer there's a seller, price is moving sideways, but all of a sudden there was a strong drop in price. Understand that the only thing that can cause prices to drop here is that supply exceeds demand at the origin of that drop. Now, we're not looking to predict this decline in price right here. We're not looking to make money on this decline in price right here. Okay. But once the prices drop here, we can conclude that supply exceeds demand here. There's a big supply and demand imbalance here. This is that big stack of sell orders on the trade desk. So what we learned to do in the program is wrap 2 lines around this level, creating this supply zone or sell zone. Remember, we want to know where that stack of sell orders is. Down at the bottom, same thing, but the opposite. Prices are trading sideways, and all of a sudden, there's a strong rally in price. Okay? Understand that when prices rally away as they do, okay, right here, that's when we could say, aha, we now know where the real willing buyers are in this market, where objectively demand exceeds supply. Okay? All right, makes sense? Okay. So once we determine there's a big supply and demand imbalance here, obviously on the demand side, this is where those buy orders are, we wrap 2 lines around this level based on a very specific set of rules and carry that level forward, creating that buy zone or demand zone. Remember, we want to remember where the buyers are. Okay? All right. Joseph, yeah, we wouldn't look at volume at all, and I'll explain why later. Okay. So we've started to identify where what supply or retail prices look like on a chart. We've also started to identify what demand or wholesale prices look like on a chart. Let's move on to step number 2, and then we'll be able to take this stuff a lot deeper. Number 2, let's learn to identify what the novice retail trader looks like on a price chart. One thing you pick up very quickly on a trading floor is that there are 2 groups. There's people who know what they're doing and make money, and there's people who don't know what they're doing and lose. There's really no one in between, right? And then you realize that every day, all that's going on, even today, trading is just this big transfer of accounts from the people who don't know what they're doing right into the accounts of those who do. So, and then you also see that the people who lose are novice retail traders. It's no secret that most retail traders lose money. So what exactly does a consistent losing novice retail trader look like on a chart? We need to learn this because these are the people who you want on the other side of your trades. I know it doesn't sound polite to say that, but this is how it works in the real world. So let's focus right here where I'm pointing, and let's specifically focus on the buyers. When we focus on the buyers here, we see these are those novice retail traders. How do we know? Because consistent losing traders always make 2 mistakes, right? Novice retail traders always make 2 mistakes. And that's how we know these are no pointer. Let me get a pointer here. Hang on. Should be. Give me just a second, and I'll get it on here. Oh, here we go. Here we go. Is that better? Can you see that black the black pointer? Okay. Hang on a second. Oh, here it is. Got it now. There we go. Now you can see a red dot. All right, great, thanks. All right. The trading is always much easier for me than the technology. But anyway, So let's focus on these buyers right here. Okay. We see that these are novice retail, consistent losing traders. How do we know? They're making two mistakes. Mistake number one, these buyers up here are buying after a rally in price. Not a smart thing to do. You would never do that. You would never buy after rally in price in other parts of your life when buying and selling anything and be consistently profitable. So don't do it here. Mistake number two is even worse that these buyers are making. Mistake number two, these buyers are buying right into a price level where the chart already told us supply exceeds demand. Here's that supply level, right? Okay? So buying after rallying price and into a price level where supply exceeds demand, big mistake. Instead of being that novice buyer, we want to be the seller. Okay? Prices fall as we would expect, and down here, it's that same group of traders making those same two mistakes. Only here we have to focus on the sellers. If we do, again, these sellers here are selling after a drop in price, mistake number one, into a price. We want to be the buyer, specifically right here at this line, whatever price that is, with a protective sell stop just below the level and our targets above. But buying right here, and we'll get into that more in a little bit, buying right here, according to our rules, is the lowest risk, highest reward, and highest probability time to buy into this market. Okay? Confirmation of a green candle, for example. In other words, don't buy until you know that there's some buyers here. All the trading books say wait for confirmation of a green candle and then buy. But if we wait for confirmation of this green candle, what's now happened to our risk? Has it gone up or down? It's gone up, right? Okay, yeah. What's happened to our reward or profit margin? It's gone down, right? We would never want to wait for confirmation. We want to buy right here when things are on sale. Now, we're going to go on and take this deeper in just a moment, but I want to take one step back. Again, it's no secret that, most short-term traders lose money, and most longer-term investors never come close to achieving their financial goals. Okay? Why is that? Well, think of it this way. Okay? Elizabeth, with the odds enhancers, I'm gonna dive into your question there. Okay, you'll get it. And if I don't, answer it. If you don't get it, just let me know. We'll explain it more. But so why is it that think of it this way: compare the average trader or investor's returns around the world to the average Wall Street firm's returns. Right? Well, we all agree it's a pretty lopsided equation. One group's making a ton of money, the other group's really struggling. Why is that, right? I mean, if it's so simple as I'm putting it right here, well, why is it so lopsided? Well, think of it this way. What does that average trader or investor around the world do? I'm talking about the average person. They buy stocks, right? Isn't that what average people do, buy stocks? Somebody answer this question for me. What is Wall Street's primary business? In other words, take the Facebook IPO. What was Wall Street primarily doing that day? Right. So yeah, exactly, Sebastian. Right? They're selling. That's Wall Street's primary business. Right? Okay. So one group's buying stocks, the average retail public, and the institution's primary business is selling, and they're making all the money. Now, I'm not suggesting we should stop buying stocks and start selling them. But what I'm strongly suggesting is you need to start thinking like that group because they're laughing all the way to the bank. It's too easy for that group. And here's why. Think of how the average trader or investor around the world is taught to do this. Okay? Okay? Think about how the average person is taught to do this. Buy a stock, for example. Everybody out there, if you read any trading book, right? Right, make sure the lesson from, and this goes back from a very young age. Remember when you were a little kid in school, all the way up to through college, and then reading the trading books. The lesson's always the same, right? Make sure it's a good company with strong management, healthy balance sheet. Make sure the company has good earnings, right? And what about the trend of the price of the stock? Is it supposed to be in an uptrend or a downtrend when we buy it? What's the big lesson? An uptrend, right? Yeah, we all got the same lesson. But here's my question to you. When all those things are true and present in a stock or in a market, where is the price of the stock or the price in that market? Is it at wholesale prices or retail prices? And I don't mean to be yelling at you. It's just we need to cover this for a minute because people don't realize how strong the conditioning is. Okay? What you need to understand is everybody on the planet is taught to do this completely backwards. Everybody from a very young age is taught to buy at retail prices and sell at wholesale prices. All I'm suggesting you do with a very simple set of rules is the opposite. Do exactly what Wall Street does. I was on that side of the business. Buy at wholesale prices and sell at retail prices. Make sense? Okay. And let me take this a step further. Right? Well, we'll do that in a few minutes. All right. So let's take this deeper, and I think you'll get it. All right. But again, that point is very key. You ask anybody. So what's your overall strategy? Say, oh, buy low, sell high. Yeah, that's what they're saying. Go look at their trading statement and see what they're actually doing. That's why you're never going to hear me reference anything from the world of conventional technical analysis, chart patterns, indicators, oscillators. All that, the first time I saw that stuff, which is probably about a year into my 8 months to a year into my career at the Chicago Mercantile Exchange, first time I saw that stuff, I thought to myself, what in the world is this? Who in the world would use this? And the guy that showed it to me said, well, this is what everybody does. I'm like, well, this is opposite of what this is the opposite of how I've been trained. Take any chart pattern you could think of, cup and handle, head and shoulders, double tops, double bottoms, any of them. Right? That's what the books are loaded with. They all have you buying after a big rally in price, okay, or selling after a big decline in price. So be careful. All right, let's dive in and let me see if I can fast forward here to there's another one I want to share with you. It's just a trade from the other day. Let's see if it's in here. Nope, it's not in here. That's okay. I tried to pull a bunch of these from recently in the trading rooms. We can start with these. That's fine. Okay. Let's go here. So here's a trade from just the other day from one of the trading rooms. Now we identified a price level in the S&P. I saw a couple questions here too. Again, like I said before, I started with this. Maybe some people came in late, but anything I'm talking about, we would apply equally to all the asset classes. So this works equally in stocks, futures, Forex options, and then any of the time frames. Small time frames, larger time frames, does not matter. Okay? So take a look. Take a look right here. Go. All right, I think we're good. Sorry about that. I meant to click on something else. All right, so take a look. Well, I think this answer should be clear. Let me do one other thing though. I want to make sure you really get this. Let's start right here because this is kind of a bigger example, pretty clear. Then we'll move on to the next one. Okay. Oh, one last thing. Make sure you understand when I say the word supply and demand, I am not talking about the term support and resistance. I definitely don't buy into that school of thought. There are many flaws with conventional support and resistance. We can get into that later. Okay. Headlines and news, no, don't change anything we're going to do. Let's focus right here. Here's a trade we took in the trading rooms at Online Trading Academy. We identified a demand level right here in the yellow area and a supply level, demand level or wholesale prices here, supply level or retail prices here, and then sold up here for a profit. Now, let me step back. What tells us that institutions or banks have buy orders right here in this level? Okay. Well, let's dive into, first of all, the pattern or picture represents that. Okay. Before someone asks, though, this level down here, we would never call this a demand level. This pivot low, we would never call this a demand level because it's a pivot low, but this we absolutely would. Here are some things. Now, odds enhancers are a list of things that help train your eye to identify these key levels. Number one, notice how prices rallied away from the level. See this rally? Would you say this is a gradual rally in price or a strong rally in price? Gradual rally in price or strong rally in price? Yeah, strong rally, right? Exactly, I agree. So what does that strong rally away from this area tell us about the supply and demand equation at the area? Small imbalance or big imbalance? Big imbalance, exactly. Okay, big imbalance. Okay. Odds enhancer number two. How much time did price spend at the level? So notice we had about 3 candles and price took off. We would say that's not many candles. In other words, did price spend a lot of time at the level or just a little time? Very little, exactly. So now here's the logic behind this one. And again, this one's going to be very opposite of the trading books. When the trading books teach us about identifying key support and resistance levels, should be okay. Is that better? Okay. Looks fine here. All right. So the trading books say when you look for key support resistance levels, look for areas on the chart where there was lots of trading activity, many candles on the screen. But think of it this way: we are looking, all your turning points in a market and all your big moves in a market always originate at price levels where supply and demand is most out of balance. And my question to you is, at price levels in any market where supply and demand is there or very few trades? What do you think? Yeah, I agree, very few, right? And that's because of the big imbalance. Now at that same price point, you have the potential for the most activity, but the reason why you don't get it is because all that potential is on one side of the market, the buy side or sell side, right? So the only remaining question is, what does that picture look like on a price chart? Is it many candles like all the trading books say, or is it very few? It's going to be very few. Make sense? Okay. All right. Yeah, Paul's saying no sound, no video. It seems like it's okay for everyone else. Yeah. So the fact that price spent very little time here, the fact that there was a strong rally in price away from a level, and the pattern or picture represents what we're looking for, we determine that this is where the banks and institutions are buying this market. So this happens to be a currency. Does anyone here, I'll tell you, there's another odds enhancer, David. I'll tell you in just a moment why that wouldn't be demand. Okay. So again, how do we, this is a currency. Who has an account size to cause a rally like this in a major currency? Is anyone with us? Does anyone in our group here today have an account size to cause a rally like this in a currency? Anybody with us here today? No one? All right, I'm just joking, but yeah, exactly. So if it's not our demand, okay, if we're not the buyer, who is? Okay, it's institutions. Remember, I started on the thing here. because sometimes I forget to do this. There's my email address, just so you have it, sam@tradingacademy.com. Okay. All right. So when yeah, this is really the same setup I use every Friday, and we usually don't have any problems. So should be okay. Let's keep going and see if it gets any better. So let's talk about step number 2. When price came back to the level, that's where we bought. But who did we buy from? That's a key component to this. Okay. Lots of thunderstorms in the Northeast. Okay. Yeah. So when price came back to that level, when we were buying down here by the red dot, who were we buying from? Okay. Were we buying from a seller who was selling after a drop in price? Mistake number 1. Were they selling into a price level where the chart already told us demand exceeds supply? Mistake number 2. If the answer is yes, and the risk here compared to the reward here, meets the minimum criteria that we're looking for, we take the trade like a robot. Make sense? Okay. So another way to say another way to say what we did, we just bought at wholesale prices from people who are trained and conditioned to sell at wholesale prices. And then we sold at retail prices to people who are trained and conditioned to buy at retail prices. Remember, everybody's trained to do this backwards. Okay? Everybody is trained to buy from us and sell to us, right? Very opposite. So, this all may sound very simple, and if it sounds too simple, and I don't mean to make it look too simple or anything like that, but there's a catch. While the logic and rules for this are very simple, doing this is not easy, and here's why. Okay. All right. When we bought here, what was the trend? What was the trend when we pushed the buy button here? Was it an uptrend or downtrend? What was the trend? It was a downtrend. Have you ever read a trading book that said buying a downtrend? No, you're never going to see it. Yet, when you buy anything else in your life, don't you want to buy it when it's on sale or when it's cheap? You see what I'm saying? Another way to say this, how many people would be a little nervous pushing the buy button here? Anybody? Would anybody be a little nervous? Let's be honest. Would anybody be a little nervous pushing the buy button right here? Carlos saying yeah, a few others, yeah. So thanks for being honest. So a bunch of people would say yeah, and Ruth has given us an exclamation mark yes, right? Do you know why you're saying yes, you'd be nervous here? Because you've been conditioned to think backwards when it comes to trading, all right? Because you're saying that because this is a chart of a financial market, right? What if I told you that this chart represented the price of that new Samsung Smart TV? And guess what? Right down here, it's on sale for half price, and there's only 5 left at the store. What are you going to do? Right? You're gonna be excited. You're gonna be scared to buy then? No, you're gonna be excited, right? Okay. You have to understand that how you make money buying and selling anything in life is exactly how you make money buying and selling in the trading markets. Make sense? The key to doing this, obviously, is learning to identify these levels, and that's what we're starting. I'm starting to teach you today by showing you the picture that represents institution supply and demand, and starting to get into the odds enhancers. We've been at this for 40 minutes now, about 35 minutes. So, giving you as much information as we can in that time. All right. All right. Yeah. So here's another odds enhancer. Okay. Here's another odds enhancer. Some people are saying, well, why would this not be a demand level? We would never call this a demand level. Another odds enhancer that we're very big on is we only want to take the first pullback into a level. We only want to buy the first pullback in price to a demand level, or short the first rally in price to a supply level. Right? Now, why is that? Well, what does this yellow shaded box represent? It represents a stack of buy orders, willing demand from banks and institutions. Okay? All right? So with each successive pullback to the demand level, to the demand level, what's happening to that demand? Is it increasing or decreasing each time we come back into that area? Right? It's decreasing. Some of those buy orders are being filled. So we only want to take the first pullback. Now the trading books will say, let the level be tested a few times, right? Let the level be tested a few times and then buy. Make sure there's buyers there. Well, we don't want to do that. I mean, what the book is saying is, don't buy when the risk is low and the reward is high and the probability is high. That the book version is saying, buy when the risk is high and the reward is low and the probability is even lower. Okay, so be very careful. All right. So this would be this that I'm pointing to now, where we bought, is as much a pivot low as this is down here, right? Okay, so we would never take a pivot low. That's conventional technical analysis support, right? We would never take that as a demand level. Here's one we took just the other day, a few days ago, less than a week ago, in the trading room. This happens to be the I believe, yeah. This is a different trading. We have a trading for each asset class at Online Trading Academy. Okay. So here we were looking at the S&P. Now this session here, market open, right? An hour before the open, and what we do is we set up our trades in advance so that when the market really gets going, we don't have to think. We can just execute. So we identified on the 31st a demand level sitting right here. Okay, this little point right here, with a strong rally out of that level. But I want to bring another odds enhancer into play here. Notice we want to look at how far did price rally away from this demand level before returning back to the demand level. Okay, so what we want to do is measure. You see the top green line here? We want to measure the top green line to the highest high prior to the pullback, and we want to compare that to the distance between these two green lines. We want to make sure that the difference is at least 3 to 1, because that's what's telling us what our initial profit zone or profit margin is for that trade. Okay? All right, and so we identified that level. A little bit later, prices came falling down, crashing down in the S&P, right down into our 1298 demand right here, where we're able to buy, and then prices turn there. That is, simple rule-based market timing. But again, look at all the odds enhancers in play. Strong rally out of the area, very little trading at the area. Price rallied more than 3 times the size of the level itself. 3 key pieces of information. Yeah, so Stephen's bringing up a good point, and so notice there was a pullback here, and I was going to get into this. Almost always, we only want to buy the first pullback into an area, but there's one little caveat to that. If the first pullback into an area barely touches the level and takes off in the opposite direction, okay, if that happens, then we're usually good buying the next pullback into the area. Okay, all right. What we require, though, we don't want an equal low to this low. We want prices to go deeper into the level. We want a lower low into the level, because we want prices to come down and reach a fresh stack of those buy orders. We want to be in fresh demand. All right, makes sense? Okay, so that's what happened a little bit later. No, we did not. I suppose you could have initiated a short maybe up here, but we didn't. Okay, we did not do that. Instead, the opportunity that day was to buy. All right. Let's move forward. Boris, I would argue that we do know what the big money's doing. We're able to identify where the orders are. You know, and again, whatever market you're looking at doesn't matter. We could be talking about, you know, I think the same day there was a great opportunity in copper as well. We could be talking about a stock, commodity, anything. Okay, it doesn't matter. Forex. All right. So yeah, and you know, in many years ago, gosh, more than 15 years ago now, you know, I was on that side of the business. So, you know, what I've done is just train my eye to see that, and it's really based on a very objective set of rules and criteria, and I'm trying to give you as much as I can today. One other thing, though, that I wanted to... so another point to really help you understand this is, you know, for those that are new to this, when we look at price charts, most people look at candlesticks, some people look at bar charts, line charts, point and figure charts, any kind of charting you can think of. What is that chart representing? The chart is representing trades that have happened, right? Or filled orders, right? Filled orders. Does everybody understand that? But if you think about it, what is the only thing that actually causes price to change direction and move? What is the only thing that causes price to move? Is it filled orders or is it unfilled orders? Is it filled orders or unfilled orders? It's unfilled orders. Does everybody totally understand that? Okay. Filled orders don't cause price to do anything. They're filled. They're there. They're done. It's unfilled orders that move the market. But that's not what the chart is representing. You see what I'm saying? Like, in other words, the perfect chart would be a chart that didn't show you the filled orders, but showed you all the unfilled orders. Then it'd be easy. Make sense? So that picture of unfilled orders is what we're really focusing on identifying on the price chart. All right. Again, it's you know, it may sound like not a big deal in any market, really in any market. So now the most important thing here. Now this trade worked out fine. But let's say this trade did not work. Let's say prices fell and went through the level. Okay, you know, that's, I think, a very key part to this. The whole point of this market timing is low risk, high reward entries. Okay, if you can do that, then everything else falls into place. But if the trade doesn't work out, it's not a big deal. It's a tiny loss. And of course, we always want to adjust our position size, so we're never risking more than we're willing to lose. Okay. Sebastian, I don't know if anybody actually has like a picture of unfilled orders, but I mean that picture. I'm saying like a whole. I don't think there's a trade desk that has a picture of unfilled orders, or a list, I should say, of unfilled orders. But the picture of unfilled orders on a price chart is what we're focusing on, and that's what I'm trying to train your eye to see. That's not difficult to see on a price chart. Okay, unfilled orders, if you know what you're looking for, are not difficult to see. And let's use this next one as a good example. So again, here's the trading room. I happen to be leading this session, and we always start with this screen here. And I'm usually going over this screen. I'm always going over this screen an hour before the market opens. And we're giving our students the supply and demand levels for the day in whatever market we're watching. This happened to be a stock trading session. XLT stands for Extended Learning Track. Great question, John. I'll hit that in just a minute. So way before this market opened, none of this action has happened yet. We identified the supply levels in the spiders from 129.10 to 129.20. That was right here. Now, what is so important about this supply level? Now, as you can see, the market was gapping down that day, and I knew that an hour before the market opened. I knew the market was gapping down. I didn't know if it was going to rally up to here or not, but what makes this such a key supply level? Number one, look at how prices moved away from the area. Strong move away. In fact, a gap. That's probably the best picture you can have. Odds enhancer number two, very little time at the level. Number three, how far did prices decline away from the level before returning back to the level? Number four, once the level was created, right, on that gap down, had prices come and retested or revisited this level up here? Okay, the answer was no. So all those things together, and there's a few more odds enhancers, tell us that there's a big supply and demand imbalance right here. This is where the institutions were selling the S&P that day. Okay? So what we do is, again, based on a very specific set of rules, we wrap two lines around this level and carry this level forward. Okay? Carry this level forward, creating a supply zone or sell zone. Another word for that, retail prices. Okay? Now, when the market gap down, one thing I don't know is exactly when prices are going to come back up here. I mean, I know, I'm almost certain they're going to come up there at some point, almost always that day, but I don't know exactly when. Remember, this is not just for day trading or swing trading. It's for, any type of trading in any market. So prices rallied up that morning, and it looked like we were going to get filled here, and then prices turned and fell in the other direction. So with this, again, if you notice, you have to have some patience. But when prices came back up into here, I want to add another component to this. Again, our strategy set to sell right here at 129.10. That was the entry point, an hour before the market opened. So now prices are at 129.10. When we sell, though, especially if you're new to this, you have to make sure you know exactly who you're selling to. Make sure you know that you're selling to a buyer who's buying after a big rally in price and into a price level where supply exceeds demand. Okay. Another way to say this, we sold at retail price. And again, if the trade doesn't work out, it's a very small loss, very manageable loss. And if the trade does work out, we're looking to make at least 2 to 3 times our risk to the first target. Hopefully it goes well beyond that. Anyway, I think you get the point. Rick, is this similar to market profile? Not really. There's again, a lot of, if you think the conventional market profile through, there's a lot of flaws to the school of thought. One of the biggest flaws is, and I'm not saying this just to beat up market profile, I just want to save you time and money, or at least get you thinking about something. Conventional market profile gives almost equal weight to every level that they identify. Well, that in and of itself completely ignores the supply and demand curve, right? So be very careful with conventional market profile. So I want to take this one step further here, okay? All right. Marissa, yeah, you know what? I saw you asked it a couple times, and I'm sorry your sound was bad earlier. Let me do this. There's my email address. This is a recorded session, so you can watch the recording, because that was a lot of the basic lesson earlier. And if you need any other information, you can always send me an email at sam@tradingacademy.com. And I'll talk more about it here. I mean, we're not done yet. I just want to make sure. I don't want you to feel like you're kind of helpless without information there. Okay? But let's take this one step further here. The goal here is not to just identify levels. All right? There's two things we have to. There's really one picture that we're looking for on a chart. It's not just where the unfilled orders are. Okay? There's another half to this. Let's talk about it now. We already have, but I want to put it together. What we want to do every day as a day trader, every week or month if we're a swing trader, and in the big time frames as well, if we're longer term traders and investors, we want to identify the picture in a market where you have institutions on one side of the market and retail traders on the other. Okay, because that specific moment in time, it represents an equation or an equation with such a predictable outcome, an incredibly predictable outcome. In other words, when we have retail traders buying and banks and institutions selling, that's when we're presented with low risk, high reward, and high probability opportunity. Okay. Now that opportunity doesn't last that long. Again, on a trading floor, and I saw this and did this for so long. When your biggest turns in price would happen when institutions are all on the buy side and retail are the only people on the sell side. Let me tell you, price is not going to stay there that long. You're going to be shooting higher very quickly. All I'm showing you is exactly what that picture looks like on a price chart. Think of it this way: if you were if you were, you know, this, I don't know what your favorite sport is, but last year, if it's football, let's say you could bet on, you were going to bet on football games, and no teams were getting any points. Okay, you'd probably bet on anybody. You'd probably bet on just about every. No, there's really only one or two games you'd bet on, right? It's probably like the Patriots against the Colts, or the Green Bay Packers against the Colts. One of those two, right? Okay. Why would you put your money on anything else when that's just a kind of a, you know, those teams are not getting points? Because it's such a predictable outcome, you're almost guaranteed to win the bet, right? It's just like maybe the Chicago Bulls this year against anybody. Same thing there. That's exactly the picture we want to identify in the price chart. Okay. No offense to Colts fans or anything like that. But again, the outcome of this equation where retail is buying and banks and institutions are selling, that's the complete picture we need to be able to identify in any time frame in any market. Let me look back here. Okay. Yeah, so as far as targets go, if we're selling at supply, our target's going to be our nearest opposing demand level, and vice versa. Okay. Yeah, and the reason why, you know, you see in the trading room here, we set these trades up before the market opens, is yeah, we just want to, you know, we don't want to do any thinking. When the market's going, we just want to execute our orders. And again, whether we're talking about stocks, futures, Forex, options, we would be having the same conversation. All right. Let's move forward here. Skip past this one. That's kind of another very similar, same example. Here's a day from not all that long ago. And I remember this was a big news day. So in the Forex trading room here, we identified a demand level in the euro, 131.97.5 to 132.06. A little bit later in the session, right, prices come crashing down to that level and rallied away from that level pretty strong, well over 100 pips in a pretty short period of time. Here is the picture that represents exactly where the banks are buying euros. This is where there's a lot of unfilled. This is where a lot of the unfilled bank orders are. Again, how do we know that? Because price could only stay there for a short period of time and took off, and of course the picture pattern represents that. But if we know that banks and institutions are buying here, that's where we want to buy. But here's the thing, on this day, and I remember this day, March 25th, there was really bad news from the Fed. I think it was on the housing market or something, and yeah, you know, another day from the Fed where the world's coming to an end. Price in the euro, and like the S&P and stuff, came crashing down. Okay? Came falling pretty hard. So again, what I'm getting at is, what I think you want to do is, once you get good at this and can identify these turning points, we want to have our orders in the market, and you know, we want to buy here with a stop down here and our appropriate targets above, and of course adjust our position size so we're not risking more than we're willing to lose, and we do that based on the distance in the level itself, and then take the trade like a robot. There's no reason to sit here and just push the buttons, right? The emotions will definitely get the better of you there. And again, out of all the pictures on this chart, this is the picture that represents demand. These pivot highs are not supply levels. These pivot lows are certainly not demand levels. So again, I know we're out of time here. I'm going to turn over to Frederick in just a moment. I wanted to give you as much as we can. Oh, absolutely. We set price targets and stops exactly, you know, as precise as we're setting our entry points. But I try and apologize for talking too fast, maybe. But I want to get as much of this information out to you as possible. So now in our Friday morning sessions, you'll be able to understand why we're, you know, honing in on such precise levels like we do, and we'll keep the lessons coming on those Friday mornings as well. So let me tell my email address here again, and then I'll turn it over to Frederick. Hopefully that was helpful, folks. And you can always send me an email if you have any questions or comments. I could certainly look forward to your emails. Yes, high volatility, low volatility. Yeah, we would identify the levels as well. All right, so again, there's my email address, sam@tradingacademy.com. Thanks again for your time, and really appreciate it. And I definitely don't take this responsibility lightly.
Thank you, Sam, very much for your presentation, and thank you everyone for attending. Do remember that Sam is presenting every Friday morning at 9 a.m. Eastern Time during the TradeStation morning market briefing series. One thing I want to do is mention the next Spotlight On event. That's going to be with Price Haley on June 19th at 4:30 p.m. Eastern Time. And you're welcome to register on the TradeStation website. So thank you everyone for attending again. Have a great evening and see you soon at another TradeStation event.